Hello, I'm Jonathan Moyes, Head of Investment Research at Wealth Club, and today I'm with David Hall of YFM Equity Partners to talk about the British Smaller Companies VCTs. Hello David, welcome to the studio. Great to have you here. I wonder if you could first start by telling us a bit about YFM and your own experience.
Yeah, Jonathan, hi, good afternoon. YFM is 40 years old this year. It's actually 40 years old on the 12th of November this year, which I think is quite a landmark. Yeah. The Y in YFM is Yorkshire, which is where the business started. And it's always invested in UK small businesses. And that's always been its focus. Admittedly, the businesses we're investing in 1982, very different to 2022. But we now operate throughout the UK with a few £100 million under management. And I'm David Hall, I'm the Managing Director, and I'm the son of a butcher from Salford.
And you've been with YFM for
I've been with YFM since 2000.
And so we're here today to talk about the VCTs, and what do they aim to do for investors?
Yeah, well, British Smaller Companies VCTs is very much, does what the name says on the tin. They themselves are 25 years old, roughly now, as venture capital trusts. And they invest in small businesses with a view to producing medium to long-term returns, which they distribute by way of tax-free dividends. And we invest in a mix of innovative, high-growth businesses that we'll talk a bit more about.
So what types of companies are you looking to back?
The types of businesses that we have now have got particular, I think, characteristics. We've always been a business services investor, so we've invested in businesses that are largely B2B providers. And over the years, that's evolved so that those services are now delivered in the main through different software applications. So the sorts of businesses that we back now are ones that provide tools to help other businesses be quicker, smarter, better, faster, more efficient at what they do. And the other thing that we kind of look for, I think, in businesses is also not just an ambition, but generally the businesses we back have a higher propensity to export than the UK average. And therefore we look for people who are outwardly looking rather than inwardly looking.
And is there anything you look to avoid?
It's a cyclical thing. So there are different vintages that will have different elements to them. So where we currently sit, you'll find that we've got much less in the way of consumer and retail, and anything which has got higher levels of discretionary spend is probably going to take less of our attention over the next couple of years.
Yeah, okay. And so management teams, what do you look for in a good management team?
Well, at the point at which we invest in businesses, it's probably fair to say that those businesses remain founder-led, and the teams themselves are probably not fully formed and won't be the full team. So the thing that we look for most with all of our businesses are entrepreneurs who are looking for a proper equity partner, someone who they can act as a sounding board and provide them advice and provide them with wealth. So it's their approach to partnership and their approach to us, which also I think reflects in the approach to business. So above all else, that's what we look for in teams. The rest, in terms of how the teams develop and the different functionality and specialisms, we can help with and grow together. But overall, we're looking for those people who want an equity partner.
Are there any red flags at all? Anything you avoid if you see it?
Yeah, well, you'd like to think that all of the red flags that we ever see that we avoid, but what we do does come with some risk. Typically speaking, as I said, if you go back to what we look for, then things that we find more difficult are where the investor like us is only being asked for just money and not anything else, not their opinion, not their advice, or those sorts of things. So the sort of thing that is the opposite to us, if you wanted, the green flag, is where the entrepreneur is not really looking for a partner or any sort of involvement in the strategic development of their business.
So can you give us some recent examples of companies you have backed?
This year, I think it's got some interesting mix in it. There's three I'd quickly draw attention to. Two new investments and one further investment. So one of the new investments that we've made is a business called Plandec. Plandec is effectively a tool to help people manage their software development teams. So it's a workflow collaboration tool. And that is as a business that has expanded to a level at the moment where they now feel they can take their first element of new institutional money to grow a bit further. And again, UK based, but looking to expand overseas. And the second one is BioRelate, which is a text analytics tool. And it used to be called text analytics. It's now called artificial intelligence. And what it does is scan medical journals, globally for information about products or drug discoveries very close to what you're looking for. So the result of that is it will cut down your own drug development time by looking at what else has been done previously, scan that information in. And then the third business is called Vualta. And Vualta is a business that helps you implement what's called ERP tools. So these are big business-wide tools, implementation tool, effectively itself implementing the tools of a business that's a unicorn called Anaplan. And that's a sort of a bigger, broader sells to larger enterprises. So three very different businesses, but all providing business tools.
And what about some of the more mature holdings in the portfolio? Any particular highlights there?
Well, I mean, I think the good thing that we're seeing this year is the nature of the businesses we're backing is that they are still maintaining their growth rates. And a couple of really good examples from that, two, again, different ones, would be Outpost, which is a visual effects business, started life very good at developing dragons' heads, which was a niche, has to be said. But it's expanded much beyond that now. So it does VFX for things like Game of Thrones, Ring of Power, a lot of the science fiction series. And that business has expanded from under 10 million turnover to this year it'll do more than 40. And it now operates in 4 different locations. So expanded from its original Bournemouth headquarters, where it's still based and headquartered, but now operating through Mumbai, Montreal, and to Los Angeles. So very much an outward-looking business, growing really quickly. Another example, and probably one of the, and it is our largest investment by size, is Matillion, which produces it's effectively now a data analytics platform tool. Sells internationally. Largest market is probably in the US now by some distance. Started life in Altrincham, where it's still based and the technology team is based, but it has a sales team now out in Denver. That business this year has grown to almost 80 million sales from the 55 that it had last year, so still growing very strongly, and operates at a place where you're seeing the movement away from on-premises to cloud management, coincide with the hungry world for data and data analytics. So that continues to drive its growth.
That was one of your first unicorns, or first unicorn?
It's probably the first of the unicorns that I think it's fair to say, but hopefully not necessarily the last. But you don't always have to be a unicorn to be great. We've got a few baby unicorns, don't get any bigger than that, but it's not a bad day at the office if you can create a business worth 200 or 300 million. That's still a good thing for UK PLC.
Yeah, very true, very true. And how do you source all these investments? How do you find a Matillion?
I mean, there's the nature of how we find things is sort of evolved over the years, but it helps having been around for 40 years and involved throughout all of the UK regions. So we've got quite deep roots and contacts throughout all of the UK, and the result of that is that you tend to know someone who knows someone who knows someone who's done a transaction in this area before. So that you tend to track the types of businesses that we're looking for now. So predominantly, the larger majority come to us through our own origination and sourcing. We get some through which are curated, if you want, through advisors, and we got a small number where There are brokers, for example, who do that. But it's a whole range of different sources. But it does tend to be that the ones that come direct to us through an introductory source who we have had some involvement with in the past usually tend to have a higher chance of converting, but not always.
Okay. And so besides funding, what do you do to help these companies succeed?
I think one of the absolute fascinating parts of what we do is when you get involved with a business on the growth journey, is there are lots of things that will happen to those businesses that can stand in their way. And equally, there are certain things when you're growing really quickly which cause indigestion. So the sorts of things that we tend to help businesses with is when they're scaling, for example, from one site to multiple sites across the world, when they're scaling a team from 2 or 3 salespeople to a fully functioning integrated marketing and sales function, all with different sorts of roles, when they're trying to develop their software engineering team and at what point do I have a CTO where I split their role between an engineering officer and a product developer. So all of those scaling challenges, not all of which are unique, but which are people are finding themselves come across the first time, we help with, and we've been able to develop a really strong group and network of people. We've got 40 or 50 investments now. They might each require 4 or 5 different sort of functional skills of which they can call on at different stages. We've developed a group and network around that we're always looking to add to help them overcome that, as well as trying to help them with the strategy. So we don't run their businesses for them, but we hope that we can help them either identify some of the hurdles or help them jump over those hurdles to achieve their own growth plans.
So changing topic slightly, 2022 has been quite a volatile year for stock markets. Is that affecting the way you invest, and how is it affecting the companies you're backing?
I think one of the interesting things about almost about life is there's almost nothing new in some respects. And so 2022 has a lot of things which are proving challenges together. And for example, the combination of inflation and interest rates is one. But for those of us who remember long enough, that is, when I first bought a house, interest rates were 18% and inflation rates were running at 12%. And in 1982, YFM was formed because there was a paucity of equity finance in the UK when small businesses were screaming out for the funding because they were suffering from labour shortages, high interest rates and high inflation. And that was 1982. That's why we were here in the first place. So those conditions are here again. So what we're seeing is that demand from small businesses for long-term equity finance to give them the headroom that they need to navigate these paths increasing, because that's the time when the entrepreneur, who always themselves are trying to balance risk and reward, looks around and goes, what do I need most? I need some stability in my funding regime. So that's what we've seen. We've seen our inquiry rates go up by about 1/3 over the course of the year this year compared to 21 and 20, which reflects that demand that you're seeing from UK PLC. And the fact that we are seeing that demand is a good thing in the end for UK PLC, because those small businesses are the ones that are going to be the engines of the growth for the next 3 to 5 years. That's
very interesting. And so have you felt the need to revalue the portfolio at all, given sort of the wider falls in the stock market? Has that affected valuations?
Yeah, well, our portfolios are valued every quarter. We report quarterly to the markets, and we are listed funds, and therefore we're required to do valuations. And we've seen 3 things that have impacted this year's valuations. So the one is the wider multiples have fallen in the markets, which we reflected in our valuations. Mm-hmm. The second, though, is what you multiply. So so there's a multiple and then what you multiply. Okay. And so what you're multiplying is either a sales figure or a profit number. Unfortunately, because of the nature of the businesses we've seen those continue to grow and increase, which in part has offset the multiples. The third thing that's affected our overall valuations, and positively, because our valuations over the course of this year, our NAVs are effectively broadly flat, has been businesses that we have realised. So where we have crystallised, valuations for the businesses that we've sold, we've achieved values somewhere in the region of about 45% more than they were on the 1st of January this year, and that's a good thing. I think the fact that we've crystallised the value, and therefore what's offsetting the falls elsewhere is we've turned it into cash, which is worth more.
So what's the biggest challenge you face at the moment as an investor?
Well, as an investor, we reflect in part our investees. So there are sort of two answers to that. So if you were to say, and when we talk to all of the entrepreneurs running the businesses, what their biggest challenges are at the moment. The number one challenge that we see in the UK for the types of businesses we're backing is labour. So it's labour shortage, tightness of the labour market, and therefore getting people, skilling people. And there's probably a broader and longer term question for UK PLC that we need probably to upskill and look at that training, I think, more. But the biggest single thing that they face is ensuring that they can get labour. So if you take our portfolio, which employs just under 4,000 people at the beginning of this year, that's increased by 20% over the course of the year. So about where we now stand, they've hired another 700 or 800 people. They wanted to hire more and not being able to. So I think that is their number one challenge. As an investor, I think you're always mindful of trying to plot the course for the next 5 years. So the challenge that you have today is not necessarily to look at all of those immediate things that are impacting what the business is looking like today. You're trying to look at what's going to impact it and stop its plans in 5 years' time. And therefore, the lens through which you're looking changes depending upon exactly what the current environment is. So what you're now looking for are resilience, and hopefully the sorts of products that we're backing and the sorts of businesses perform slightly better when times are hard, because if businesses are looking to work smarter, quicker and more efficient, they tend to do even more of that when times gets a bit tough.
And so how risky is this part of the market? How risky are your VCTs?
Well, venture capital trusts by their nature are meant to take risk. Right? They exist because the government providing the tax relief, which all our investors like, and the government wants us to take risk. They exist where they say, well, there's what's called market failure. So in other words, to invest in businesses that the market itself wouldn't invest in without the benefit of the tax relief. So they come with risk. They're also very young businesses. The typical business at the point we invest has only got 20 odd employees, and it's probably got a couple of people running a management team, and it's 3 or 4 to 5 years old. So there's plenty of risk in there, and probably 1 to 4 or 1 in 5 of those businesses won't necessarily achieve their plans. Doesn't mean that we'll necessarily not get all the money back. We'll tend to get some recovery on it, but they're probably not going to achieve their plans. So it comes with risk. But as I'm sure if my compliance officer was here, and to be honest, she's always on my shoulder anyway, she would say the past is no guide to the future. Mm-hmm. But the thing is with UK SMEs is, whilst they come with risk, so there is return, and the two go hand in hand.
And often returns come with, that means exits ultimately. Any recent exit examples you can?
Each year we have a number of businesses that we sell out of. We try and use the word realisation rather than exit. Exit always sounds a bit final, like I've just left the building. Whereas if we'd realised something together, perhaps we can go and do it again. And we do invest in serial entrepreneurs, so we tend to use realisation. Mm-hmm. There's a couple of businesses. Interestingly, both businesses this year have been acquired by US businesses that I could talk to you about, the most recent ones. But one was a footfall business. That's how it started life, a footfall counting business called Springboard. And it's a very typical journey of the sort of business we invest in. Invested in it for 8 or 9 years. Its product strategy changed over that period of time. It ended up being much more a data analytics tool. So it took the footfall information and started to do things with that. It was essentially selling only in the UK at the point that we originally invested, and then it launched in the US, and eventually that's where it's been sold to a US business. And of course, it's always a good one to talk about because I suppose for two reasons. The first was we made more than 4 times our money on it, and the second is it's probably prompted the dividends that we've just announced and are paying to the market shortly, which is sort of 4.5p on one fund and 2.25 on another. So that's a sort of everybody wins, and even better, we've perhaps still got a chance of getting a bit more deferred consideration out of it in 2023.
And is that the typical YFM business, sort of B2B, data analytics, sort of business services?
It's probably what I'd call the median business. Yeah, the types of those businesses. I could have picked lots of those different ones. It doesn't mean that we haven't occasionally got retail, but if you take 80% of our portfolio, it's probably around those sorts of areas. 20% is in a variety of other generalist things that move over time. But I think you're probably right to say about 80% of the portfolio at any one time you'd expect to be in those types of businesses, and that's very much the sort of thing that we're hunting in.
So you mentioned dividends. What are you targeting? Can you continue to achieve it?
Yeah, interesting. We've never actually set an absolute target. I mean, there is a dividend that's paid each year, which is usually around about 5% of the NAV. Typically, our dividends have been between about 7 and 9% over any metric, whether it's 3 years, 5 years, or 10 years. But there is a bit of volatility in those dividends, and I think that's something that our investors have now come to understand and also expect, because the nature of the businesses in which we invest, they don't realise in nice even patterns. They're very much a bit London busish and cyclical. So what you do tend to find is that any one year your dividend could be quite high. So last year, for example, our dividend yield was 10% because we'd sold some quite strong assets during the course of the year. But broadly speaking, we've tended over any measure over any time to it comes out as an average between 7 and 9, but it can vary between 5 and 12.
Okay. And the performance of the VCTs as a whole, how are they performing?
Well, we're performing, I think, as I said to you this year, I'd describe it as an even year in terms of valuation, but that's put it in a top quartile performance for the year. And generally speaking, we've been consistent over a period of time. So our VCTs have always tended to be in and around either the first quartile or the second quartile. But if you'd invested them at any time, they've been the most consistent performers over 5, 10, 15, 20 years. That is based on an AIC website, and I can refer to the prospectus.
We'll have to check the data.
Yeah.
So finally, to sum up then, David, for those who want to invest in a VCT this year, why should they choose the British Smaller Company VCTs?
Well, we're always very grateful when everyone does choose British Smaller Companies VCTs, which is the first thing I would say to everybody, and hopefully we'll be good stewards of their money. There are 3 things I'd say. One is where we deploy capital, which is where we're investing in businesses that we think should have, on balance, as an asset class, some resilience in the current marketplaces by providing those business tools. The second is that we've invested through different cycles and generally been able to deliver those returns. And the third thing I'd say is that, which is a more general comment, but there's risk in everything that we do. But backing UK PLC businesses in high growth areas has plenty of its rewards. And fortunately, we've been able to share that with our shareholders over many years, and hopefully we'll continue to do that for years to come.
David Hall of YFM Equity Partners, thank you very much.
My pleasure.
If you are watching on YouTube, please press like and subscribe to the channel for more.